Good day, guys. Welcome to this YouTube channel. If this is your first time on this class, please click on the red subscription button to subscribe to this YouTube channel so that when I drop more educative video content, you get notified. So in this class, we're going to continue our previous class. On our previous class, we're going to build more on it, which is standard costing. But for the purpose of this class, I will focus my attention on variance analysis, and I'm going to be looking at the overhead variance. So I'm going to be looking at the overhead variance. So one thing I want you guys to know is that when it comes to the overhead variance, we have majorly two types of overhead variance. We have the variable overhead variance and we have the fixed overhead variance. Yeah. So we are going to look deeper into them. So before I proceed with this class, we've had some couple of videos before this particular one. So if you have not watched those videos, I'll indulge you to watch those ones. I'll drop the link under these ones so that you can watch them before coming here. So yeah, let's go. Overhead variance. But before you proceed, there's something you need to know when it comes to overhead. We call it overhead absorption rate. What's overhead absorption rate? Overhead absorption rate is simply equals to total budgeted level of total budgeted overhead, total budgeted overhead divided by total level of activity. So I'm not going to be dwelling much on this. I already have a video where I explain overhead, absorption, everything that relating to overhead. So and with this formula, I explain everything there. So if you've not gotten it, I'll drop the link under this one also, so that you can watch out for it before coming back to this one. So let's proceed. Overhead variance. Let's see what we have. So in this class, I'll only give the formula. We'll take some questions, then we solve. So now when it comes to overhead costs variance. So when it comes to overhead cost variance, there are majorly two types I'm going to look at. We have the overhead expenditure, overhead expenditure, or you call it overhead expenditure variance, and we have the overhead efficiency variance. That's variable overhead. Please take notes, not just overhead. So when it comes to variable overhead cost variance, we have the variable overhead expenditure variance, and we have the variable overhead efficiency variance. So I'm gonna take it one by one. We look at the formula. What's the formula for? Now, one thing I want you guys to know is that anytime you hear the word efficiency when calculating variance, just know that it has to do with hours. So whether you're dealing with labor, material, whatever, if you have anything like efficiency, it has to do with hours. So take notes, guys. So now when it comes to variable overhead expenditure variance, the formula is simply standard rate minus actual rate multiplied by actual hour. So this is the formula for overhead variable overhead expenditure variance. The standard rate that we have budgeted minus the actual rate multiplied by the actual hour. When we get to formulas to solve questions, I will explain better on this. So variable overhead efficiency, I told you it has to do with hours. So the formula is standard hour minus actual hour multiply by variable overhead absorption rate. Variable overhead absorption rate. So like I said earlier, this is the formula for calculating variable overhead expenditure variance, variable overhead efficiency variance. Then when we match them together, we have the variable overhead cost variance. So let's take a question, let's look at how it works, or let's even look at the fixed cost formula before we even look at the question. So let's go. When it comes to fixed overhead cost variance, when it comes to fixed overhead cost variance, there are also two. It's also divided into two. So we have the fixed overhead expenditure variance, fixed overhead expenditure variance, and we have the fixed overhead efficiency variance. So we have the fixed overhead efficiency variance. Sorry, I have to shorten it because my body is not long enough to cover that. So now, fixed overhead expenditure variance. What's the formula? The formula is just budgeted level of activity, level of overhead. Let me put it that way. Budgeted level of overhead minus actual level of overhead. So the formula for the fixed overhead expenditure, you see, one thing I want you guys to know before I even really proceed is that this variable overhead cost variance follow the patterns of the variance we'll be treating earlier. You know, we treated direct material cost variance, labor cost variance. This follow the same pattern. As a matter of fact, if you go and watch those videos, there's a pattern I explain where when solving the variable overhead efficiency, when solving efficiency variance, there's a pattern you must follow. If you go and watch that video very, very well, there's a pattern I must follow where I use the to get my standard hours, I use the actual whatever, I multiply it by the standard rate. If you go and watch it, so this actually follows the same procedure. Standard rate minus actual rate multiplied by actual hour. This follows the same procedure. The only thing that differs here is just the variable overhead absorption rate. But when it comes to this, it's quite different from others. That is why I want you guys to pay attention. So the fixed overhead cost variance is divided into two: fixed overhead expenditure variance and fixed overhead efficiency variance. So the fixed overhead expenditure variance is budgeted level of overhead minus actual level of overhead, quite different from every other patterns we've been following. That's why I need you guys to pay attention. So the fixed overhead efficiency variance is just simply, I said it earlier, that whenever you're having efficiency, it has to do with hours. So standard hour minus actual hour, you multiply it by the fixed overhead absorption rate. Your standard hour minus actual hour, multiply it by the fixed overhead absorption rate. Don't worry, when we take a question now, you will see how we apply all these formulas, how to calculate them, the patterns they follow, and let's go ahead to take a question. So welcome back. So we have a question. Let's go. It says Datex Limited specializes in the manufacture of kente for export and local market. The following information relates to the company budget for a given month. So budgeted production quantity is 120,000 meters. So this is the budgeted information that we have budgeted, the standards. So we have direct material. Material A is 0.5 kg, which is 1,200 a kg. Material B is 0.5 kg, which is 1,600 a kg. Direct labor 30 minutes, which is 6,000 euros per hour. So variable overhead 30 million euros. Fixed overhead 15 million euros. So we told that production overhead is absorbed on the basis of direct labor hours. Yes, that is where I need you guys to pay attention. That production overhead being absorbed, we are going to be using that. Now, actual result achieved during the period during June 2000 are as follows. Production is 130,000 meters. Direct material purchase, we have material A 80,000 kg costing 88 million euros. Material B 70,000 kg costing 98 million euros. We have direct labor hours 80,000 hours worked costing 400 million euros. So variable overhead, the actual is 28 million euros and fixed overhead, the actual is 18 million euros. So for the basis of this class, what I'll majorly focus on in this question is the variable overhead and the fixed overhead. That's what I'm going to be calculating in this question. So but the first thing, whenever you want to calculate anything that has to do with overhead, whether fixed or variable, the first thing you need to do is to calculate the overhead absorption rate. Overhead absorption rate, the formula, let me start with variable now. Let me start with variable overhead expenditure variance or variable overhead cost variance. So overhead absorption rate for variable overhead cost variance. Now, overhead absorption rate is, now how do you calculate the overhead absorption rate? You just look for the budgeted level of overhead. That means the overhead in the standards. So budgeted level of overhead level divided by budgeted level of activity. Budgeted level of activity. Now, the question is overhead absorption, budgeted overhead level. If you go back to the question, in the standards that we were given before we have the actual result, we were told that the variable overhead is 30 million euros. So that is the budgeted amount of money we intend to spend on variable overhead. So that's my budgeted overhead level is 30 million euros because that's what we intend to spend on variable overhead. So I'll say 30 million euros, or let me just come here, 30 million. If you go back to the question again, there's a particular point where they told us that production overhead is absorbed on the basis of direct labor hours. So production overhead both variable overhead and fixed overhead, they are telling us that they are absorbed on the basis of direct labor hours. So what do we have to do to get the budgeted level of activity? This your budgeted level of activity can be in hours, can be in units, can be in whatever you are being told. But in this question, we are told that it is in hours because production overhead is absorbed on the basis of direct labor hours. So I told that it's hours. So what did I need to do? I need to calculate, this is my budgeted overhead level. I need to calculate my budgeted level of activity, which is my budgeted total hours. And that's what I need to calculate. My budgeted level of activity, budgeted total hours. So what is my budgeted total hours? Let me go back to the standards that we're being given. So in the question, we're told that 30 minutes direct labor, 30 minutes, if you look at the direct labor, we're told that 30 minutes is what they spend to produce one goods. I mean, for them to produce one unit, they will spend 30 minutes. So what does that mean? Let me convert this 30 minutes to hours. If I convert it to hours, that'll be 30 divided by 60 minutes because 60 minutes will make 1 hour. So I'm going to be having 0.5 hours. Now, 0.5 hours is what it takes an employee or a laborer to produce one unit. The question is, how many units do we budget to produce? Now, if you go back to the question, is what we budget to produce 120,000 units. Now, if I budget to produce 120,000 units and it takes me 0.5 hours to produce one, then you accept with me that to produce 120,000 units, I'm going to be needing 0.5 times 120,000, right? Because it takes me 0.5 hours to produce one, and I want to produce 120,000 units. Then 0.5 times 120,000 will give me number of units it takes to produce this 120,000 units. So I'm going to go, if I do that, that's going to give me 65,000 hours because it takes me 0.5 hours to produce one. Then how many hours will it take me to produce 120,000? So 65,000 hours. Is it 65,000? Sorry, that should be 60,000. Sorry. Yes, 120,000 multiplied by 0.5. That should be 60,000. So I'll come here. I'm going to say divided by 60,000. So that will give me 500 naira per or 500 euros per labor hours. My variable overhead should be absorbed at 500 naira per labor hour. So that means that in one labor hour, variable 500 naira will be absorbed. In 1 hour, 500 naira of variable overhead will be absorbed. This is what it means. So 500 per labor hour. So now let us now proceed to calculate our variable overhead expenditure variance and our variable overhead efficiency variance. So let's start with variable overhead expenditure variance. So variable overhead expenditure variance. So the formula that I gave earlier is standard rates minus actual rates multiplied by the actual hour. Now the question is the standard rate. The standard rate is what I just calculated here because I use my budgeted overhead level, which is 30 million, divided by budgeted level of activity, which is 60,000. So that gives me 500 per labor hour. This is my standard rate. That means for 1 hour, I should cover 500 naira of variable overhead. So let's go. My standard rate is 500 naira. Did I know my actual rate for now? No. Did I know my actual hour for now? No. So let's go ahead to calculate my actual hour. Now, if this is what we budget, then what is the actual? We will do something to get the actual. We will do something similar to this using the actual results. That's what we are going to do. So if you go back to the actual result, total variable overhead that we eventually incurred or that we eventually use, which is our actual result. You accept with me that in the question they told us that variable overhead, which is the actual, is 28 million naira. So I'll do something similar to this using the same information that was given, but not in the standard now, in the actual. So variable overhead, we told that 28 million is the amount I eventually spent on variable overhead divided by my labor hours. So how many labor hours do we have? So if you go back to the question still, we're told that direct labor hours, 80,000 hours worked costing 400 million. So that's 80,000 hours. So 28 million divided by 80,000, 350 per labor hours. So we intend to cover this, then we have this. So this is the standard that we propose at first, and this is the actual result. So we go 500 minus 350. Then I multiply it by what is my actual hour? That's the question. My actual hour is in the question. We're told that direct labor hours 80,000 hours. So direct labor hour is 80,000. So 12 million. So is this a favorable variance or an adverse variance? Now let's proceed. That is all about variable overhead expenditure variance. So let's proceed to calculate the variable overhead efficiency variance. So variable overhead efficiency variance. Now, if I told you that whenever you hear efficiency, it has to do with standard with hours. So standard hours minus actual hours multiplied by the variable rather overhead absorption rate. So now, do you guys know how we calculate the standard hours? I've explained it in my previous class, the patterns we follow. I took my time to explain how this is gotten so that you guys will not be mistaken. So the question, we're being told that the direct labor for producing one direct labor minute for producing one is 30 minutes, which is 0.5 hours. This is the hours it should take to produce one unit. But now, if you now produce how many units do we produce? If you look at our actual results, we were told that we produce 130,000 meters. So if we produce 130,000 meters, then how many hours should it cost us using this? So that's why I told you guys to get the standard is your actual output multiplied by your what? Your standard rates. I've explained this pattern in my previous classes. So if you don't understand, you have to go back to those classes. I took my time to explain it why it is like that. So the actual output we have, or the actual output we later produce, eventually produce, is 130,000 meters. So to get this, my standard now is 0.5 times 130,000 meters. If I've budgeted that it should take 0.5 hours to produce one under normal working condition. So if I produce 130 units, then definitely I should not spend more than 0.5 times 130,000 units. So that will give us 65,000 hours. That will give us 65,000. So the standard hours is 65,000 hours minus. Now, what is my actual hours? If you look at the question, we're told that direct labor hours is 80,000 hours. So my actual hours is 80,000. Now, according to my standard, this is what I should have spent 65,000 hours, but I eventually spent 80,000 hours. So, what is my variable overhead absorption rate? So, if you look at this, it follows the same pattern with variable overhead cost variance, follows the same pattern with what we have been doing earlier. It's only the fixed overhead that's quite different. So, different, and that is what you just have to try to learn the discrepancy between them. So now, what is my variable overhead absorption rate? I think we've calculated that before. Variable overhead absorption rate, and that is 500 per labor hour. So 65,000 multiplied by 500 per labor hours. You ask me why it is 500 per labor hour. Why is it not the actual, right? Now, come, let me explain why. You see, one thing about variance is that look at this first one we calculated here. What do we use? Actual hours. If you are calculating one and you use actual hour, then for the other, it must be standard. Do you get it? That is the ideology. If you've calculated one variance, this variable overhead cost variance is divided into two. So you calculated expenditure variance and you use actual here. Then if you are calculating the efficiency, you should not use actual, you should use the standard. Go and watch the patterns of all the variants I've solved in my previous classes. You see that they follow the same pattern with what I just explained now. So now we have 15,000 give us 7,500,000. Is this an adverse variance or a favorable variance? Of course, it's an adverse variance because I budget to spend 65,000 hours, then I eventually spend 80,000 hours. It's an adverse variance. So this is all about variable overhead cost variance. Let's look at fixed overhead cost variance and let's see how we can, break into it. Welcome back. So now, fixed overhead cost variance. We follow the same pattern, but fixed overhead cost variance is quite different from every other variance I've been calculating. Now, fixed overhead cost variance, I said it earlier that for you to calculate the overhead absorption, for you to get any overhead variance, you need to calculate the overhead absorption rate. Now, for fixed overhead, what is the overhead absorption rate? Of course, if you go back to my question, in our standard information, we're told that the fixed overhead is 15 million naira. So my budgeted overhead level is 15 million euros rather. So 15 million euros divided by what's the budgeted level of activity? We are already told in the question that all overhead should be absorbed on the basis of production on the basis of direct labor hours rather. So how many hours also does it takes in the standard to make the unit you want to make? I think we've done that earlier, and that is 120,000 because it takes 0.5 minutes, if 1.5 hours, 30 minutes to make one, and the what we budget to produce is 120,000 units. So 0.5 times 120,000, that will give me 60,000. So divided by 60,000, 250 euros per direct labor hour. So let's go. What is the um fixed overhead expenditure variance? Fixed overhead expenditure variance. Now I gave the formula earlier. I said the formula is very straight and direct. It's just the budgeted level of overhead minus actual fixed overhead. So it's very straight and direct. One thing about fixed overhead is that it's very different from others and very simple, straight and direct. So fixed budgeted overhead minus actual fixed overhead, whatever fixed budgeted minus actual is what will give us the fixed overhead expenditure variance. So if you go back to our question, our budgeted overhead expenditure variance, which is this. So if you go back to the question, we're told that fixed overhead, we're already given self. Fixed overhead in the question is 15 million naira. That means that is the amount. You see, this fixed overhead expenditure variance is just that the amount I intend to spend on fixed overhead variance minus the actual amount I spent. Very simple as that. Don't stress yourself. So the amount I budget to spend on fixed overhead variance has already been given in the question as 15 million euros. So my budgeted overhead is 15 million euros minus. So what is the actual amount I spent on fixed overhead? If you go back to the actual result that we were given, we're told that we spent 18 million euros. So 18 million euros. So I intend to spend 15 million. I eventually spent 18 million. So definitely I've overspent how much? 3 million. And that is an adverse variance. So you can see that fixed overhead is quite different from every other one we've been solving from the start. It's quite different. So just understand the pattern of those ones and try to learn fixed overhead in its own particular way, peculiar way. So we have fixed overhead efficiency variance, fixed overhead efficiency variance, which is the last one for this class, is standard hour minus actual hour multiplied by the fixed overhead absorption rate. So standard hour minus actual hour multiplied by fixed overhead absorption rate. Now, listen, this efficiency fixed variance does not follow the patterns of all other efficiency. That is why I emphasize on it that there's a big difference between fixed overhead and every other types of overhead. So listen attentively, it does not follow the same pattern. Now, how do I get my standard hours? My standard hours, instead of using any actual something to calculate standard hours, no, we are going to use all our standards to calculate our standard hours. Now let's go. What is my standard hours? That means that in my budgeted or standards information, how many hours do I intend to spend on fixed overhead? Let's go. We're told that our fixed overhead should be 250 per labor hours, but how many hours do I intend to spend? If I am producing in the standard information that we're given now, we're told that to produce one unit is 30 minutes, which is 0.5 hours, multiplied by how many units do we want to produce? We want to produce 120,000 units according to our budget. 120,000 units. So that gives us 60,000 hours. So we come here, our standard hours is 60,000 minus. Then, if you go back to the exact question, what is our actual hours that we spent? Going back to the question, our actual hour in this question is 80,000 hours. So we intend to spend 60,000, but our actual is actually 80,000 hours. So 60,000 minus 80,000 hours multiplied by the fixed overhead absorption rate. So what is the fixed overhead absorption rate? Which is what we calculate here, which is 250 per direct labor hours. So 250 per direct labor hours. So standard hours, we intend to spend 60,000, then actual we spent 80,000 multiplied by the fixed overhead absorption rate. So you can see it's very direct, doesn't have anything to do with the former way or former patterns we have been calculating it. That gives me 5 million, and this is an adverse variance. because I intend to spend 60,000 hours, then I eventually spend 80,000 hours. It will cost me more, whether I like it or not. This is an adverse variance. We've come to the end of this class. Please, if you don't understand anything, take your time to go back and look through it, and give this video a like, share it to your friends so that when I drop another video, you get notified. In my next class, I'll be explaining the sales variance and advanced variance, total, mix, yield, and every other form of variance. Thank you. I'll see you in my next video class.